Hi guys, so I'm back again with another video. So let's quickly do a few more practical sums so that if a new sum comes in the exam, you know how to do it. Also, I'm trying to split these videos up into multiple videos so that if it's a 25-30 minute video, you'll not watch it. I know because you'll be like, nahi ho payega. So that's why I'll just break these up into smaller videos so that at least ek ya do you can see, right? So zoom screen. Okay, so let's take a very simple example over here first. Okay, these are all examples that I've taken from the ICAI study material. And again, let me delete these things because I had already explained them earlier. So that's why I had the figures. Okay, so let's concentrate on this sum first. So the first sum is this one. MK Limited manufactures and sells a product whose selling price is 40 and the variable cost is 16 rupees per unit. Fixed cost is 4,80,000 and the annual sales are at 60% margin of safety. Calculate the rate of return net of sales assuming income tax. So for this purpose, we are skipping the income tax part because this has not been done in class. So I'm hoping that this won't come. But other than that, rate of return on the sales can come. Okay. So to calculate the rate of return, I've split it up into multiple small parts. Okay, and I would suggest that you do these things because it helps you kind of formulate the steps in which you have to proceed. So first, very simple question, like what is how much is the contribution? How do you calculate the contribution? Okay, so how to calculate contribution? Selling price minus variable. Okay, so selling price is 40, variable cost is 16, so my contribution comes to 24. This is very easy. I hope everyone gets this part. Now it's given that fixed cost is 4,80,000. So if my fixed cost is 4,80,000, what is my break-even point? Okay, so break-even point is a point at which there is no profit or loss. So how do we calculate the break-even point? Fixed cost divided by contribution. So to calculate the contribution to be done. So calculate the break-even point. We would do what? 4,80,000 divided by 24. That would come to 20,000 units. Okay, so I've just put it over here. Okay, right. So break-even point units for me is 20,000. So at 20,000 units, I have neither income profit or loss. Now, what is the concept of margin of safety? So margin of safety is basically that safety margin of the number of units that I'm going ahead with, which is so that if my fixed cost increases by some level, I can still use that, I can still kind of sustain my business. So very important part of this is 60% of margins, 60% of what? 60% of break even point or 60% of actual sales. Okay, so margin of safety is 60% of actual sales, not 60% of break even point. Okay, so in this case, actual sales, let's assume actual sales was 100%. So my margin of safety is 60 and my break even sales is 40. Okay, so basically break even sales, the top break even sales is 40%. On top of that, I'm 60% and total sales is 100%. So I know that 20,000 is my break even point. So if 20,000 is my break even point, what is my margin of safety? Just by calculating like that, I'll get it divided by 40 into 60, 30,000. So what is my total? This plus this. Okay, so 50,000 is my total actual production. Now, if I put 50,000 over here, I'll get the total units multiplied by selling price, and I'll get a contribution of this much. Contribution minus fixed cost is 48. 4,80,000. Sorry, 12 lakhs minus 4,80,000 gives me a profit of 7,20,000. Done. Now, uh, now it says that calculate the rate of return on the sales. So see, net, always whenever they say net, it's basically net of taxes, but because we are ignoring it, it will directly be profit divided by sales. So 72 divided by 2 lakh, which is 36,000, 36%, sorry. Okay, if it was profit, I would have reduced profit, and then whatever figure would come, I would divide it by selling price. Okay, so very simple example. I hope you guys have understood that part. Now, should I continue with this one or? let me just